That has grown significantly, as you will see on the next slide, from about 160 billion. A lot of the growth that we have seen recently in East Africa and Sub-Saharan Africa has been driven by mainly public expenditure. Those who live in Kenya will attest that the number of roads, fancy roads, and big infrastructure projects that have been going on there have been quite significant. And that's, we can talk about SGR as well in Kenya. For the context of Uganda and for all the delegates who flew in from Kenya, you've seen that nice flash 4-lane highway from Entebbe Airport that's been recently constructed. The dams that have been put up in the northwest of the country, costing about $3.2 billion. All these are things that have been driving growth. However, agriculture, which still employs about 80% of our population, hasn't had as much impact on the growth aspect. There are some positives in this picture, as you will see there. Total exports from East Africa about $15 billion, of which the sector of the people seated in this room contributes 10%, about $1.5 billion, which is significant, and that's how relevant that the sector is from an East Africa perspective. However, if you try and look forward, yes, we have grown sufficiently. However, East Africa still needs a lot of money. We estimate that East Africa will need up to $79 billion in infrastructure spend alone over the next 10 or so years. We can talk about the $25 billion needed for oil and gas. To what I spoke about earlier, the fact that we expect rates to come off in the EU and the US is a positive, because it's possible for us to source cheaper financing for this. So this graph here is an interesting one, and it tries to break down how growth has been moving across East Africa over the past you can call it 30 or so years, and where we see growth going. So by far, Uganda has had the highest level and the fastest growth up until 2010, 2011. But Kenya has had the most consistent growth rate. Uganda, we can say we came out of a war in the 1980s, so the percentages could be large, but the actual numbers are not that large. A lot of the growth that we have seen here, as I spoke to in the previous slide, has been driven by infrastructure spend, public expenditure. And the challenge that we put to policymakers is, how do you make that growth more inclusive? How do you make that growth more inclusive for farmers and for people in the agricultural sector? How do you make it more beneficial for the wananchi? Because a lot of the money gets brought in from China, is spent, and the normal wananchi doesn't necessarily benefit. So where do we see growth going forward? This chart is quite interesting because it speaks to what's been happening in Kenya. Kenya has done brilliantly well over the last 4 or 5 years from a growth standpoint. In the Kenyatta years, as we'd like to call them, average growth has moved from about 3.5% to close to 5.5%. But as I've mentioned earlier, a lot of that has been pushed by infrastructure spending rather than more collective spending. Services sector has also been growing quite significantly. We know because of M-Pesa alone, Kenya has one of the highest penetration of telecommunication in the world at over 82%, which is amazing. More developed countries are even struggling to get to 60%. However, when we try and project the growth of Kenya from here on, we see a few issues that could cause us some concern. Last year, as was eloquently mentioned by the professor yesterday, there was a spur in productivity, agricultural productivity, because of the good rains. Especially tea production went up quite significantly. This year, in the first half of the year, we saw that delayed. That the good professor yesterday, when talking about climate change, mentioned that good rains could even surpass a heating environment in terms of promoting productivity in tea. So we noticed that because of a delay in rains in the first half of this year, it's likely to impact tea output, and you would be seeing that already in the sector, and it's likely to also impact overall growth for Kenya. We still know that 80% of the livelihoods in our economies comes out of agricultural sector, so rains are quite important. And now just to speak about something that's close to the heart of any exporter, currency. So as a bank, we typically do projections of where we think the exchange rates will go. Currently, that chart shows that the forecast for exchange rates for the next 12 or so months is not going to be quite significant. We don't expect the Kenya shilling in this particular case to depreciate significantly. We need to highlight some risks that have come through most recently. In Nairobi especially, we talk about demonetization and the impact it has had on the market. So demonetization has forced people to take their money into the banking sector, and as a result of that, there is the belief that there's a lot of these shillings will force some sort of depreciation in the currency. So we have also seen increased dollar buying. We, however, do not see this going beyond October, when the whole process is supposed to end, and we think that this is a short-term event. Additionally, to point out for Kenya, we see that the country still has sufficient reserves at about $8 billion. So any sort of depreciation in the currency, the central bank will be capable of meeting it. Last but not least, Kenya has benefited from the tax amnesty that started in 2018. The Kenya shilling remained relatively stable because of the increased inflow of dollars, estimated somewhere between $2 billion coming back into the Kenyan economy out of the tax amnesty that was provided last year. So out of everything that I've said here, for an exporter looking at a stable exchange rate environment over the next 6 to 12 months, it could be prudent, as you'll see by the orange line there, to potentially look at taking out some sort of hedges, foreign currency hedges, to make sure that you beat your selling rate forward rate for tea beats the current forecast that we have. I move on to Uganda here briefly. So unlike Kenya, which has had startled growth from a private sector credit standpoint, growing at still single digits thanks to the rate cap, Uganda, on the other side, over the last 12 months has grown significantly. Private sector credit in Uganda has gone up by about 12%, now currently at about 14%. This has increased demand for imports, and these are good imports. As we get from the Uganda Bureau of Statistics, a lot of these imports are coming from the agriculture, the industrial and manufacturing sectors, which means that we are producing, the economy is growing quite actively. However, and adding to this, typically when we see an increase in the import bill, you expect the currency to depreciate. The Uganda shilling was remarkably stable over the last 18 to 24 months, and that is explained by a significant increase in what we call foreign direct investments. The Bank of Uganda tells us that our import bill in the last 12 months increased by about $2 billion. However, foreign direct investment has at the same time increased significantly. There's about an extra $1 billion that has come into the country that has helped the currency remain relatively stable. You cannot talk about Uganda and the forecast and don't talk about oil. We have been startling with so-called final investment decision, and as a country, the expectation is that will be done by the end of the year. However, as and when it's done, there's going to be an extra potentially $25 billion that has to be spent in the region, not necessarily Uganda alone, but Uganda, Kenya, and Tanzania on different projects. And that should have a big knock-on effect for development in the region. So a bit on what the themes that we are seeing in the tea sector as I get close to winding this up. So there are themes that were spoken to yesterday, and I'm sure during the course of most of today they will still be spoken to. There is a drive, there's been an oversupply of tea. Countries like India, which have always been traditional producers of tea, are ramping up production. Kenya in 2018 had one of their best years in tea production thanks to the good rains. We see a growing demand for affluent teas because of the health drive, especially in the Western economies, and that from a production standpoint we'll be able to guide. On the consumption side, China has always been and remains the largest consumer of tea, and the amount they're likely to export is likely to reduce further and further. as we project. Overall, the Economic Intelligence Unit projects that tea production is going to go up by just about 5% within the 2019 period, and that's likely to be driven by the Asian production, mainly from India. I've spoken to this, and many of you will know this, what's been going on in the tea industry for the last 1 or so years. Oversupply in 2018 led to lower prices. There's been both demand and supply shocks in the tea sector. Supply shocks coming from the fact that there was too much supply in 2018 that should come down a bit in 2019. Demand side shocks being that there's a big elephant in the room called Pakistan. So Pakistan imports about a third of all the tea processed at or sold at the Mombasa tea auction, which is valued at about $550 million. However, just a month ago, Pakistan, because of all the economic issues they've been having with debt amounting to about $15 billion, got a bailout package from the IMF. That bailout package of $6 billion came with some really stringent conditions. One of the conditions was for the government being required to devalue the currency to increase competitiveness, as well as increase taxes and revenue mobilization in the country for them to be able to pay off a bit of this debt. What we have seen in just the last 1 month alone is that the Pakistan rupee has depreciated by about 15%. So 15% of the value is gone. Currently it's trading at about 162. Actually, from a year ago, the Pakistan rupee has moved from 121 to 162. That is a 33% depreciation. So to people who supply tea to a country who have reduced their purchasing power by a third, there is a need to think of new markets or potentially other sources of demand. Sorry. So in conclusion, I've spoken about quite a bit on a global scale, but also from our standpoint as a bank, where do we see the risks? One, we expect that there will be increased availability for foreign currency funding for those who would like to embark on any development projects, thanks to the loosening of monetary policy in the major economies of the world. We do not see a recession happening, meaning that Africa and East Africa will continue benefiting from so-called portfolio inflows. There is a risk of the Chinese trade war with the US escalating. There is actually a G20 summit happening on Friday, which is tomorrow, and one of the things high up on the agenda is a potential agreement between President Xi and President Trump to avoid any more increase in the sanctions in the tariffs on Chinese produce. Even if there's no direct impact on Africa, the impact on the world will reverberate if China's exports are impacted significantly by an additional $200 billion of tariffs. There is a need here for if you come back to East Africa, there's a need for the government of East Africa to continue fostering investment in the private sector and reduce this public sector-based growth. For Kenya especially, there's been a lot of talk around the rate cap lifting issue over the last 2 years, and every time we sort of making small steps but haven't really made a significant step. In the budget speech just 2 weeks ago, it was still reiterated that there is at least political will to lift the sanction, the rate cap. But what that impact has on smallholder farmers especially is that it's reducing access to credit and impacting the level of growth. We are seeing some supply side risks, as I've mentioned, from the slowdown and late rains that we saw the first half of this year for the East Africa region, thanks to climate change. Demand side risk is significant with Pakistan ongoing economic wars, and therefore there is a need to diversify markets and potentially look at working on producing more unique teas that are for the affluent in the Western world. Overall, we expect the currencies in the East Africa region to remain relatively stable for an exporter. There could be value for you looking at hedging your currency exposures with some potential forwards. Ladies and gentlemen, thank you very much for listening to me. I hope that was useful.
Yeah, thank you very much, Mr. Edward Kenneth Kitungulu. You can see he's really broken it down, simplified it, even for a lay person to understand what's really happening around. Well, he's intimated about the two elephants, and when two elephants